Hey guys, the Federal Reserve just flipped the stock market and made it easier for investors to actually get rich. Now, the Federal Reserve has raised the federal funds rate again for the 10th straight time in a row. The Fed just raised the federal funds rate by 25 basis points. That's a quarter of a percentage point. Now, in this video, I'm going to explain to you what this means for you and me as consumers and what it means for us as investors in the stock market who want to build our wealth and become rich. Now, first of all, what does a 25 basis points hike in the federal funds rate actually mean? Well, the federal funds rate is usually expressed in a range. Right now, with the 25 basis points increase, the federal funds rate is now at between 5% and 5.25%. So to put that in perspective, guys, just a little over a year ago, the federal funds rate was down around 0%. Now it's up between 5 and 5.25. Now, the federal funds rate is the rate that banks charge one another for overnight lending and deposits. And the whole point of the Fed raising the federal funds rate is to basically slow down spending by making it harder and more difficult to get loans and making the cost of money more expensive. Because when the federal funds rate goes up, it has a trickle-down effect on the rest of the economy. Now, keep this in mind, guys. If the Fed keeps raising rates and raising rates, ultimately, it could cause perhaps a recession and maybe excessive job loss down the road. Now, wait, what is a recession? A recession is simply when the economic growth slows down and people are not out buying so much, but it slows down significantly. Now, the Fed doesn't want the economic activity to slow down so much. Now, they do want it to slow down a little bit. And that's why you keep hearing them use terms like mild recession, right? The Fed keeps talking about a mild recession because they really want to see a mild recession. They don't want an all-out, full-blown shrinking of the economy in a recession, but they do want a mild recession, right? And by the way, the problem with excessive job loss means consumers stop spending altogether because many people getting laid off and don't have money, and that can also lead to a recession as well. Again, the Fed wants a mild recession. So guys, it's kind of a balancing act, right? Another thing to note is that the Fed recently, just in the last few days, has changed their language that they're putting out to the world, right? Before, in the last 9 or 10 months or so, the Fed was always saying that additional firming of interest rates and of the economy may be appropriate. But they totally dropped that language. And that language is basically saying, hey, anticipate further rate hikes. But they've totally dropped that language now. And now they're saying we're looking at lags and financial developments to determine future rate hikes or what they're going to do in the future. So they sort of changed how they were wording things. And that change in semantics tells us that there's a change in their philosophy and sort of a shift in how they're viewing what they're looking at to make determinations about future rate hikes or perhaps no future rate hikes at all. So in the latest press conference, they continued the talk of the dual mandate, right? Price stability and maximum employment. And I did a video about maximum employment, guys, that you should check out at some point. Maximum employment doesn't mean they want everybody working. They want employment that's consistent with a 2% inflation rate. Now, how they go about determining all that, guys, I'm not the expert, but I'm just telling you that they don't want everybody working because that would be a problem. So my thing is this, guys, the end of interest rate hikes is upon us, is right now. I believe that the Federal Reserve is not going to be increasing interest rates here in the next several months, which is great for those of us that have money in the stock market. Because there's a lot of folks that are sitting around right now, guys, that are looking at their stock portfolios and are almost to tears because of what's been going on with stocks in the last year or so. But guess what, guys? Those times are changing, and they're changing right now. When the Fed stops increasing the federal funds rate, stock market goes up and sort of rallies, right? And that means the value of your stocks, your index funds, your mutual funds, they're all going to go up. So the real question, though, is did the Fed indicate that it's an end to their policy of increasing rates? Or did they sort of leave the door open for maybe more interest rate hikes down the road? In my opinion, guys, they signaled that this is the last rate hike for a while. I sort of heard in the press conference, Jerome Powell's mood sort of switched, right? That's the chair of the Federal Reserve right now. His mood kind of switched and took a change from a hard stance to more of a much softer stance on this 2% inflation that they've been talking about. In fact, he even used the term 2% over time. In other words, maybe they don't expect to get down to 2% now, but over time they do. And he actually stressed that. Now, also, we know the recent trouble with bank failures, right? There was a third bank that went down here recently, and it was bought out by JP Morgan Chase. And what's happening in the banking sector could have an effect on the Federal Reserve's decision to continue rate hikes or not down the road. Now, specifically, Chairman Jerome Powell said that when mid-sized banks are more restrictive in their lending to consumers, it actually helps the Federal Reserve's policy because it means that banks are not extending loans to people as willingly. They have tighter restrictions on passing out loans. And that works in tandem with the Federal Reserve's policy of increasing rates. It means basically less extensions of credit to people. So ultimately, less spending. And that's what the Fed actually wants as well. So this banking crisis has sort of been good in some ways for the Federal Reserve, trying to get to their ultimate 2% annual inflation rate. And so he noted that there's going to be several factors that the Federal Open Market Committee is going to be looking at down the road when it comes to maybe increasing the federal funds rate or not. All those talking points leads me to believe that this is probably going to be the last interest rate hike for a while. Now, we already know that inflation has been cooling down with the CPI numbers around 5%, which is lower than it was last year. Last year, this time is around 8.5%, 9%. So we know that CPI numbers or the inflation is going down really, really slow, right? Not quite at the pace that the Fed wants. And economic growth is showing signs of slowing down. So here's what all this means, and here's why all this is great for us that are investing in the stock market. The Federal Reserve made it clear that any future policy actions are going to be based on future events that take place in the economy, right? When the Fed Chair Jerome Powell says point blank, we removed a specific sentence in our last report about additional firming up of the market, that's another indicator to me that they purposely left that sentence out because they don't necessarily anticipate future rate hikes. Now, that's what I heard from the press conference, guys. If you heard anything different, drop a comment below and let me know what you heard at the press conference. And for me, guys, here's what this means for us that are invested in the stock market. I think this means a short rally in the market right now. Right? For us that have money invested in the market, I think we're going to see a slight turnaround and good days could be ahead shortly. Now, down the road, 6 months, I can't tell you that. But I think here, closer to where we are right now, we're going to see some turnaround in the stock market. Now, of course, I can't predict that for sure, but that's just what I think. And also keep in mind, guys, there's some lag time that's still happening. There's some things that are indicating a slowdown in the economy, and there's some things indicating a slowdown in the labor market as well. In just a few days, we're going to get a labor report that's going to show us whether or not the unemployment rate is up or down and where that is, guys. And that's going to play a role in what happens in the future as well with the federal funds rate. Hey, guys, it was never in the past supposed to be possible for unemployment to be at a 50-year low and the Federal Reserve at the same time to raise interest rates from 0 to almost 5%. Those two things going on at the same time, guys, sort of defies the typical history of the economy. But what I think we learned is that they're going to pause rate hikes. This means that if you're a stock market investor, guys, now's the time to be investing. And if you aren't in the stock market, you need to get in the stock market and investing immediately. And I'm talking index funds, ETFs. Now, I'm not a big single stock person. I like index funds and ETFs primarily. But if you like single stocks, a lot of them are undervalued right now, and you need to get on that immediately. This is the time when you can be making some money. This is the time when wealthy people get rich. When they see that things are down in the market, but there's a possible uptick in the very near future, you need to be in the market and investing. So this is why I'm telling you that right now, the Fed has made it possible for you to get rich in the market and buy now before this mild recession actually happens. Now, when that recession happens, keep investing, right? Don't pull your money out when the recession is going on and things start to hit rock bottom and the unemployment rate starts to go up. People start losing jobs and you get these breaking news reports. So make sure you're in the market right now so you can be taking advantage of this uptick that's going to happen, as well as the possible upcoming mild recession that we may see. You need to be already invested in the market when that happens. So hey guys, if you got anything at all out of this video, do me a favor, smash the like button, drop me a comment. Do you think this is the last rate hike for a while, or do you think there'll be more shortly? And why? Drop that comment below, guys, and also subscribe to the channel if you're not a subscriber. I'm going to keep you updated on what's happening in the U.S. economy. We also talk money management, real estate, growing and investing your money, etc. on this channel, guys. Check out a few of these videos also for more. Hey, the best person to take care of the old you is the young you. Do me a favor, take care of yourself and take care of other people. Until the next video, peace.